Welcome, everyone. Welcome so much to Gordon Hay from Redbourne Wealth Management. Thank you so much for joining us in support of our COVID-19 rapid fire video series. As you can see, we're not filming on location in the kitchen this morning, and we're not anywhere else in the country either, but our brilliant experts are still here. We are still here. And this morning, we're going to be subjecting Gordon to yet more interrogation. He's well used to it by now, but we're going to be talking about financial planning for individuals right now in a COVID-19 world. So, Gordon, are you ready to be interrogated?
I am indeed.
That was the right answer. Thank you. So I'm going to kick off this morning, Gordon, with my first question, which is a big one. The world markets right now are insane. They're all over the place. What's your take on what's happening to people's investments, to the state of the investment community right now?
I think it's a reaction from the markets to essentially what's a lockdown of most of the developed world. Most of the main economies are probably going to plummet into recession in the very near future. It may be short, maybe sharp, but most of us are going to go backwards. It's going to be a period of negative growth. And what that then does is causes business failures during that period, which then leads to rising unemployment, larger social security bills, and less money in the economy generally. So when investment markets are always looking forward, they're saying what's coming ahead of them, and that looks like a pretty dark period of recession, and therefore that's reflected in the falls in the markets. And what people will have seen from the headlines is we're looking at the FTSE being down 25% from the start of the year, and the American market, the Dow Jones, being down 23%. So it's quite a sharp fall in those markets. However, what I would say to clients is very few clients are invested wholly in the UK stock market or the US stock market. So whilst the headlines are 25% and 23%, their actual investments, their pensions, their ISAs may only be down a fraction of that, maybe half of that if they've got a well-balanced portfolio. So the headlines are pretty bleak in the world markets, but to the individuals, it may not be quite as bad as that.
Thank you, Gordon. And for the medium to longer term, how long do you think we're going to be in this situation? Can you see things bouncing back? Do you think we'll bounce back quickly when we do bounce back? What do we have to look forward to?
I think it will be a pretty steep or short recovery once it actually happens. I think what nobody knows is when that point's going to be. Nobody can call where the market's going to be. So we think short term, the next 6 months, there'll still be a lot of volatility in the markets. If the lockdown goes past the start of the summer, so say we're in June, certainly into July, the markets may fall further during that period. So we'll see a lot of volatility, a lot of overreaction to good news and bad news. Medium term, and by medium term, I probably mean 12 to 24 months for a change. There will be some large business failures. Now, there's serious pressure on the holiday companies, the airlines, the whole leisure and retail market. Those will bite in the 12 to 24 month period when they don't pay out dividends and things like that. However, historically, we've seen this with Black Monday in 87, with the dot-com bubble, the housing crisis, 9/11, the financial crisis. Longer term, markets do tend to recover and recover very strongly. So I think it's a volatile period, short, medium term, lots of bad news. Longer term, for longer term investors, there is some light at the end of the tunnel.
Yeah, something to hang on to, I guess. Let's talk about tax reliefs then. So let's focus very much on the things that as individuals we may be able to do, or at least to start planning for right now. What kind of tax reliefs are there available for individuals?
Well, this is now the start of the new tax year virtually in April 2020. And most people at this point are looking to do their pension contributions and ISA contributions. Those are the two main tax relievable vehicles or tax efficient vehicles clients will use. What we're seeing this year is rather than people maybe rushing to invest straight away or to maximize the pension, we think particularly your self-employed and business clients may leave that until later in the tax year. First objective is to protect the business, make sure it's still trading, and then second will be to look to get money for the business, save money for the future. So we still see people looking at ISAs and pensions as a first port of call, but the timing may be more towards the beginning of 2021, the end of the tax year, when they'll actually make those contributions when they're confident they've got the cash and the business is still viable.
Yeah, I mean, let's talk a moment on pensions and pension schemes. Is there anything that as individuals we should be doing right now? I mean, you mentioned that people will probably hold back from putting more money into pension schemes. I think none of us have any spare cash right now to be saving or putting into pensions. But is there anything else we should be doing or thinking about right now in terms of the money that's there already? Should we be talking to financial advisors, talking to people like yourselves about where that money is, moving it around, taking advantage perhaps of the opportunity to buy low? What can we do?
I think there's a couple of things. Certainly, you should be talking to your advisor about what your options are. I mean, clearly the valuation is going to be a lot lower than it was historically. Yeah. I need to know what risks you continue to have going forward, and are you comfortable with that? I think there's a couple of things in there in terms of paying in on a regular contribution to a pension is actually quite efficient at the moment, because you're buying the units, the shares in your investment relatively cheaply. Same if you're bold enough and going to put a lump sum, you could argue you'd get really good value for money buying in investments at the moment or buying into pensions at the moment. And of course, you've obviously got the benefit of the tax relief on the pensions. Now, on a bigger picture looking further forward, the government have to get this money back from somewhere that they're using to support the economy. Tax relief on pensions is incredibly generous, especially for higher earners, and it may be that may have a short shelf life. So I certainly think speak to your advisor, look at how much you're putting in and is it affordable to you as a business, review your investments and think, can you be able to put money in at the moment, and you may well get a larger benefit at longer term.
Yeah. I mean, do you think, Gordon, we should be thinking of selling our investments and moving to cash as a reaction to what's happening now? Is that a sensible ploy to make?
It's often what people think is a good idea, but it tends to be sort of after the event. The market has fallen. If you sell into cash, you crystallize those losses. And how are you going to get those back? Cash at the moment pays about 1.3% at the top end. So if you've fallen 10, 15%, you're not going to get that back through a cash investment. We also know from sort of behavioral finance, when clients feel more pain with the loss than the joy they feel with the gain. So it's a very difficult moment for clients. But recent research in the likes of Schroders have shown that if you leave money invested long term, you can potentially double the return compared to jumping in and out of the market. And if you just lose those best 10 days of performance, your fund could be cut in half because you've lost those last 10 days. And it's like we saw last week, I think the FTSE jumped up 9% in one day, which is unheard of, absolutely incredible. But if you were out of the market, you lost that bounce back. So I would say, if you can, stay invested. All the research shows it recovers. You benefit from staying invested if you can.
Okay, that's good advice. Thank you. I mean, we're obviously doing a lot of planning and reviewing right now, and when we have a small amount of mind space to do this, and that's where I guess financial advisors are so helpful. But should we, I mean, it's a horrible topic, but should we also be thinking about life insurance, whether that's adequate? Should we be looking at wills too? Gordon, what's your advice on those?
My advice is to go to that big pile of papers we've all got sitting in the corner of the kitchen somewhere, which we haven't looked at for 5 years, which is all your pension statements and your ISIN statements and your letters from your solicitor, and sit down and write out a list of what you've actually got. And write down what you'd like to happen in your estate. And this is the perfect time to do it. We're actually seeing a huge amount of activity from our clients, basically putting their affairs in order. This is the first time in a very long time they've actually had time to sit down and do it properly. So this is exactly the moment we're urging clients to sit down and review it. We're doing a new review document with all our clients, which is really about the management of their estate, who their executors are, how they want their will to work, how they want their business will to work. And this is the perfect time to do it for everybody.
Good, great advice. Is it, I mean, you touched on this a moment ago, Gordon, is it a good time to invest more if you've got a bit of ready money sitting to hand? And if so, where should we be investing that money?
I think it's for experienced investors, dripping money into the market at the moment probably could pay off longer term. However, I would not encourage any novice investors or people new to investment thinking they can jump in and make a quick kill and get back out again. It's just too high risk at the moment. I would continue to drip feed in regular investments through your pension scheme and through your ISAs. And if you have a little bit of cash, it may not be a bad time to put a little bit of cash in but I would say relatively modest amounts.
Okay, great. Let's talk about mortgages now, Gordon. I mean, obviously, many of us are applying for the mortgage payment holidays. We're being really sensible about getting in touch with mortgage lenders, hopefully, and reaching those compromise arrangements. But what if you were about to buy a property, you were about to get a mortgage? Are mortgages even still available right now? Can people even move? I mean, the government's telling us all to stay put, but clearly there is quite a build-up before you can physically move property anyway. So can people still get a mortgage and start planning for moving?
They can, yes. Hopefully it'll only be short term, but essentially the mortgage lenders are still lending money. What they've done is drop the criteria. So some are lending up to 95% of the value of the property. Most are now down to the maximum 60%. So it's going to obviously cut off part of the mortgage market to a lot of people. And the delay is going to come really on the transaction, the move to exchange and contract, because they can't get valuations done for the mortgage company and for your own peace of mind. And they physically often can't get the paperwork around quick enough, get the checks done by the local authorities, etc. So what we see is the mortgage market is still active in certain markets. Most lenders are honouring existing offers they've made to clients, so that will continue. There will be a long delay, we think, between exchange and completion, because we're physically not able to move house at the moment. Maybe new builds might be slightly different. And that'll have the impact of sort of stagnant property prices, we think, for a period of time. Maybe small, maybe gently going backwards, just because the market will just freeze up. However, one of the things we think is, with everybody sitting at home with a wife and kids and the four walls around them, people will want to move house pretty quickly after we're free to move again, because they'll have realised how small their house is. So we can see huge pent-up demand. There always is in the UK anyway, but in the housing market generally. And we can see a lot of activity once things go back to normal in the housing market and property prices rebounding if they have fallen back and probably beginning to move ahead again. Brilliant, Gordon. Thank you so much for sharing all of that with us. That's it for this session's questions. As ever, Gordon's materials will be on Farillio. Look out for the Twitter feed as well. You can find it all there when we go live. Thank you again, Gordon, so much for supporting this COVID-19 series. That's all for now, folks. Be safe, keep going. We will beat this together, and we'll see you again very soon for more Q&As from our brilliant experts. Take care.